Welcome to another episode of the Odd Lots podcast. I'm Tracy Alloway.
And I'm Joe Weisenthal.
Joe, it always feels to me like it's earnings season. Isn't that right? I feel like every month it's earnings season. It just goes on forever.
I know. It's always earnings season. It's always like about to be Mardi Gras in New Orleans. Like there are certain things that it's like, oh, that's this time of year again. Like certain things, it's always like Carnival in Brazil. And it's like, oh, that's happening again. And yes, earnings season is always right around the corner. These things that just seem, I think that they feel like they're supposed to be rarer than they seem to be.
Yeah, they happen 4 times a year, but it seems like it's constant. Maybe this is one reason why we historically haven't done a lot of earnings episodes, but I think now is a good moment to actually stop and reflect on what we've been seeing from companies, because of course, all of this feeds into the big macro inflation discussion.
Well, 2 things about this is like, one is economists should listen to what companies say more often, I feel like. There's so many economists, and I love them, but there are so many economists out there who, you know, like they'll have some chart about the money supply or the Fed or some like the dot plots and all this stuff, and all that's great, and I love it and everything. But often, like, companies are just telling you what's going on. And a lot of my favorite sort of like economics analysis comes from someone who's just like, let's listen to the conference call and hear what management has to say.
Right. There is a tendency for economists to talk about inflation expectations in the sort of abstract sense, but you could just read an earnings transcript and look at a big food company, for instance, and see that they're saying, oh yeah, we're going to push through some more price increases. And that would be a pretty big clue.
And why? And this also gets to, and the nice thing about conference calls too is, you know, the analysts represent the interests of investors, right? And so they're asking the questions that investors want to know about. And one of the things that we've explored for years on this show is the degree to which companies care about investors. And we talked about it a lot with oil specifically. Oil companies for years maximizing drilling output versus price, then switching post-pandemic and so forth. So these conference calls give a clue on both sides, and that help drive corporate behavior.
Totally. So on this episode, we are going to be trying to, I guess, draw that line between the micro and the macro, talk about earnings and what it means for the wider economy. And I am very happy to say that we do have the perfect guest. We are going to be speaking with Samuel Rines. He is a managing director over at Corbu. You might recognize his name if you've been subscribed to the Odd Lots newsletter. I've written a little bit about his work recently, but he's been writing some very good analysis of earnings and specifically the pricing strategies that companies are undertaking in the current environment. So Sam, thank you so much for coming on Odd Lots.
Hey, thank you for having me.
So, I first started reading your work, I guess it was last year, and you've developed this idea that you call POV, price over volume. Can you walk us through exactly what that is?
Sure. So basically going back to, call it early 2022, it was kind of this realization that something was going on underneath the surface with corporations that was pretty interesting. And that was they were making the decision that they didn't really care about losing a little bit of volume, and they really cared about kind of finding how much price they could push and how much the consumer would react to it. And the first really interesting example of that we pulled out was Pepsi. And Pepsi, we called it the new PPP. It was what was going to bail investors out after the Russia invasion. And it was the Pepsi pricing power. Pepsi found that even though they had about 4% of their revenue exposure to Russia, they could push price everywhere else and make up for that volume without any problem.
Wow.
So it's this really interesting kind of first tidbit, right? Corbu, we tend to really focus on what's going on with the geopolitics and try to drive down into that and figure out how to kind of play around it. And it was really a revelation, at least to me, when Pepsi was pushing double-digit pricing.
This is so fascinating. I'm already like blown away because to me this opens up a whole new way of like thinking about some of the questions and tying things together. But let's stick with Pepsi for a second, because when the invasion of Ukraine happened, there were certainly a lot of people who understood some pretty straightforward ways that could be inflationary, right? Energy, grain costs, etc. But what you're saying is there's this other mechanism that happened that you only would understand by sort of looking at the micro, where a company felt pressure to raise prices elsewhere to compensate for the loss of sales in one market so that they can continue to deliver steady results for the investors.
Yes, and it certainly wasn't just Ukraine. It certainly wasn't just that. They also had, they have Frito. So there was some.
But that was a factor in everyone around the world, to some extent, who is a consumer of PepsiCo products, was to some extent paying more to compensate for the lack of revenue and earnings that they were getting from the Russian market.
Oh, exactly.
Wow.
And it was pretty immediate. It was not something that was just a subtle pause. It was something that was very, very quick.
Can I just real quickly on this? Did they say like this? We raised prices in these markets. How do you know that that's the reason?
Oh, it wasn't. They never explicitly stated it.
Okay,
right. It was they had an excuse to begin raising prices.
This is exactly what I wanted to bring up, because like it does feel like in the environment of the past 3 years, you've had a lot of supply chain disruptions. It feels like there has been a peg for companies to go out and say like, well, because of this, we need to raise prices. And this is something, Joe, that actually came up on our episode with the baker, right? He said explicitly that if something is going on with, for instance, the price of eggs, if there's an avian flu outbreak and it's national news, it's an opportunity to increase prices without getting a whole bunch of pushback.
And that is exactly it, right? A lot of companies had these, call it one-off or very, very rare excuses to raise prices and begin to find how much the consumer would take. And one of my favorite examples of this is Wingstop. Right. It was national news that chicken wings pricing was going through the roof, right? And it was something like 125% year over year at one point. And Wingstop began to push price, and they had zero pushback from the consumer, right? The consumer just continued to buy chicken wings. And it's not as though there are a limited number of places to go buy a spicy chicken wing.
Right.
They pushed it and pushed it and pushed it. And now chicken wing prices have fallen somewhere around 50% from their peak. And Wingstop is not exactly stopping pushing their price. In fact, they're saying and guiding towards a typical 2 to 3% type price increase. So it's a really interesting, once you get that price push, once you figure out that the consumer is willing to pay it, that is margin expansive over time as you begin to have a normalization in your input costs.
So are there any examples, like what other publicly traded companies also sell a lot of wings?
Ooh.
I'm trying to think. But I guess
Buffalo Wild Wings?
They went private.
Oh, they did.
They did. Oh.
But I guess the reason I ask is because, intuitively one would think that if Wingstop is raising prices, some other company could use that as an opportunity to gain share. And so in your reading of these transcripts, why don't we see that effect of play? I get it. Wingstop, they're a company. Why wouldn't they want to push price to see where that breaking point is, maximize returns? Why do you not see other companies then say, okay, well, we're going to try to make it, we'll take a lower margin for higher volume?
Because they can raise price right alongside of them and have those larger margins. I mean, it's one of those things with Pepsi, right? Pepsi, Coca-Cola.
Yeah.
You shouldn't have Pepsi being able to push price in theory.
Right.
It should be Pepsi and Coca-Cola battle it out and you have very minimal price increases and they don't have the ability to really play catch up with inflation. And that's simply not the case right now. They're just willing to take it.
So what did Coca-Cola do when Pepsi was raising prices all around?
Raise prices right alongside of them.
Interesting.
And took a little volume hit.
So this actually leads nicely to something else I wanted to ask, which is how much of this is a sort of food consumer goods story versus other types of manufactured goods? Because certainly reading your research, there's a lot of talk about Pepsi, Wingstop, Smucker's, Texas Roadhouse, which is one of my favorite.
This is episode making me. I haven't eaten yet today. So
I'm sorry. Actually, neither have I for once. Okay. So how much of this is about food versus other sectors?
Oh, it's really interesting. So I kind of divide it into three categories: goods, services, and leisure. And just to kind of break it up into a way, kind of a framework to work around it. And so if you look at services like Texas Roadhouse, again, that's kind of food. But they're raising menu prices. They're also guiding to higher wages. Same with Cracker Barrel, kind of the middle America businesses are raising their menu prices, and they're guiding to 5 to 6% wage gains. They're pretty explicit about it. So it's kind of price over volume with a side of wages.
In the interest of journalistic integrity, Tracy just IB'd me during this conversation, reminded me I did have some turkey jerky.
Joe is literally sitting there surrounded by empty jerky wrappers saying that he hasn't eaten anything.
So when I said
today.
that I haven't eaten a proper meal today, I am not on a completely empty stomach. I do not want to deceive the listeners, and so I want to issue a correction right there.
Correction.
Right. Where were we?
Yeah.
Well,
and on the good side, just really quickly, because it's interesting. So there's this smaller company, Donaldson, that does filtration systems. And they guided to a 2 to 6% revenue gain in the coming year. And then in the fine print said with 6% effective pricing.
Wow.
So, you can kind of do the math there and figure out that that's 0% volume at the top end of the guide.
I love the flow of this conversation because, again, it leads very naturally into my next question. But why aren't consumers pushing back?
Well, to Donaldson, for Donaldson, it's not just consumers, right? It's the corporations that buy their filtration, customers that buy their filtration stuff. Why aren't they pushing back? It's a combination of wage gains and that you're feeling a little bit wealthier, right? This is a world where inflation doesn't feel necessarily as forced on the consumer. And the consumer, there's not a whole lot of options when you're trying to figure out whether you're buying Pepsi or Coke or Fritos or Lay's. It's a strange thing, but you look at the wage gains coming through the system right now, and the wage gains make people feel a lot wealthier, particularly, Social Security benefits rocketed in January. People are feeling much wealthier, particularly in the lower deciles of income.
I fully admit to being in a total, a certain economic bubble here, living in New York City. But it is a very frequent conversation where people complain. It's restaurant prices are crazy these days, et cetera. Yet also, people are still going out to eat, and people complain about how hard it is to get a meal or get a table or a reservation at a restaurant or order delivery. It's I gotta stop ordering Uber Eats or Grubhub or whatever. It's just insane that I'm paying $55 all in fees for 2 dozen chicken wings, and then people keep doing it.
This makes me think also how much of this is a speculative question that's hard to answer, but how much of it is just people are traumatized by a year of lockdowns? We all want to get out and live our lives. Maybe we don't save a lot for the next couple of years, but we finally get to go out. We get to book travel, go on cruises, eat nice meals at restaurants.
Wait, Tracy, can I tell you some bad news?
Okay.
We're coming on 3 years of this.
But I was in Hong Kong.
No, I know. And the lockdowns are finally over, but this has been a very long year.
All right, fine. But I do think there is a sort of psychological explanation here as well.
Yeah, this is speculation, but what COVID did for a lot of people, including myself, was it shortened the time horizon of spend, right? The life cycle model began to put some volatility into that, and you began to put some volatility into whether or not you were going to be able to do the things you loved, right? And kind of going back to this, services question, when you look at RevPAR for the major hotels, occupancy really isn't back to 2019 levels yet. But the average amount of money that they're making off the room has skyrocketed back well above 2019 levels. So again, price over volume, there's a certain level that there's, a price push on the consumer. And the consumer, yes, occupancy levels are going higher, but the average room rate is going much higher. Same with cruises, right? Cruise capacities aren't back to 2019 levels, but pricing is well above. Norwegian came out with a really interesting earnings report recently where they said, hey, bookings are really, really good, and they're well above 2019 pricing levels. It's just across the board on the pricing front.
So from a cost perspective, a typical major national hotel chain or a Norwegian at this point, are they seeing much cost inflation?
Hotels, somewhat on the labor front, that's really where they're seeing their costs begin to move higher. On the cruise front, bunker fuel
But overall, they're expanding margins when they push through these prices, despite the fact that like they haven't even gotten back to volume levels. These are beyond what their costs are rising.
Correct. Yes.
Okay, because that's very easy to see. That's just math.
And over time, it's going to be very, very good for them.
Sam, you mentioned something about customers having limited choices. For instance, Coke versus Pepsi, which is not exactly true, but point taken. And this is an issue that has come up a lot, this idea of corporate concentration, and that as the marketplace is dominated by bigger companies, bigger and fewer companies, they have more pricing power. Is that something else that's playing a role?
It's certainly playing a role to a degree. It's because, if you see Pepsi raising price, you have call it permission to go raise price. And it wasn't just Coca-Cola that raised price. It was Dr. Pepper Snapple. They took price over volume, and and now Keurig is in there as well. But Keurig took price, and Smucker's on Folgers took price. And those are the kind of you can kind of think of that as coffee at home.
Can you talk a little bit about the questions that are being asked on these calls? Because presumably, right, an analyst wants to be able to go back and, sort of like, the information is ultimately, the information they're trying to extract is the information that the holders of stock in these companies want. What are analysts asking or sort of implicitly telling management about what investors demand these days?
Sure. So there was an interesting question. This was a couple of quarters ago on a Wingstop call, where one of the analysts asked, "If wing prices fall, what are you going to do? Are you going to go after volume? Are you going to go back after volume and market share?" And I believe it was the CEO responded with, "No. You can think of this as a level set on pricing, and we believe that our brand can dictate that type of pricing going forward." That to me was very indicative of what was going to happen, and they followed through with it. Wing prices fell, and they said, "No, we're still going to creep prices a little bit higher here. Margins are going to go higher." Another interesting comment, and this kind of goes to where I think a lot of things are going to flow on the price over volume front in the coming quarters. There was a very interesting call with a shipping company that for some reason I'm spacing on at the moment. But management had said, listen, Q1, Q2, it's going to be a pretty difficult time for us. But looking at the end of Q2 and into Q3, we see an inventory cycle beginning to emerge again. And so when you're raising prices, if you're Pepsi that said we're going to raise a little bit of price, if you're Coca-Cola, if you're any of these companies that have seen Kimberly-Clark, that have seen those inventory levels at the end retailer creep lower, you're looking at the potential for not only higher pricing going into the back half of the year, but also a restock on the volume front. So it's a really interesting one.
So the big inventory glut that a lot of people were predicting, you don't see evidence of that in the current earnings results?
So there's some inventory glut, particularly with companies like Target. Target, it's a POV world. I don't know where they're living right now. I mean, when Walmart is pushing price over ticket, on their tickets and having lower foot traffic, that to me is indicative of something being very wrong with Target. And then you go to something, you kind of want to check
just
on
their merchandising. Just to be clear, because Target is not raising prices, right?
Target's not raising prices, and they're not getting the mix shift that Walmart might be seeing in a meaningful way. They don't have traffic and they don't have pricing.
So
but this is interesting because then you get Contour, which owns Lee and Wrangler, right? If you think it's something to do with clothing, if you think it's something to do with merchandising, I mean, Wrangler and Lee put up a 7% revenue gain for the quarter. It's a really interesting kind of, and then there's Dollar Tree. I mean, Dollar Tree had lower number of transactions at a higher price.
I'm wearing Wranglers right now, by the way. I need to actually two things. I feel like this is the point to interject and point out that Odd Lot's regular guest, Isabella Weber, is out with like a new paper on inflation. And she talks a lot about some of these exact same things. Everyone should go read it, including also there was a PepsiCo call that she cites the same thing where the analysts were like, but you're not going to go back to like cutting prices, right? Like at the end of all this, are prices going to like mellow out, or are you going to go low? And the management, the way they phrased it, according to her, is like, because we are a very innovative company, we do not feel like we're going to have to like compete on price.
Yeah.
On Walmart, Target specifically, can you talk about Walmart is probably a pretty great proxy for aspect. What is Walmart doing specifically? What is their strategy? And how much does it deviate from the everyday low prices, which I sort of thought of as Walmart's calling card for the last 30 years or whatever?
Yeah. What is Walmart's strategy? Walmart's strategy is being at a lower price point than, call it, Target.
Okay.
And the interesting part there is that they have a significant grocery business, which is also meaningful, and they've done a very good job on that front. And that's where a significant amount of their, call it, price gains are happening, right? They don't have a significant amount of traffic going up, but they do have a significant amount of pricing coming through the system, and a lot of that is food inflation. And Target does have grocery, at least some of them do, but they simply haven't seen the consumer going there to shop for groceries. And Kroger came out, and they're doing well on the grocery front, and so it's very much a grocery and a higher turnover type world, which Walmart dominates over Target.
So broadly, POV is intact. Consumers are not yet really pushing back against it, but maybe on the margins, we've seen some adaptation. So I know, I think in like the recent Fed minutes, they were talking a little bit about consumers maybe changing their preferences. And then we also have this explosion of private label goods. So companies like Walmart selling their own brand of groceries at lower price points than, say, I don't know, Smucker's or Kraft or whatever. To what degree could that start to impact the POV strategy?
Private label is, to a significant degree, part of POV, right? It gives the consumer the second option. And when you begin to see Kroger, I think their own brand, the Our Brands, was plus 10% in the latest quarter. You are beginning to see private label take some share, but it's not taking enough share to matter against the pricing power. So, kind of to your point on Smucker's, I mean, they guided to 6% net sales, 8% organic. And then in the fine print said, listen, we understand that there's going to be some volume down, so that's going to be all price. And that was for 2023.
Wait, sorry, explain that last part again. What was this?
So this was Smucker's.
Okay.
Right. So it's like Jif peanut butter, that type of deal. And what's interesting about them is they said 6% net sales growth, 8% organic. All of that's going to be pricing. And we understand that there will be an elasticity on the volume front. So if you get,
but they're willing to take that because if they could push 8% price increase and only a 2% volume decrease, then that's a good trade.
It's a great trade.
How does that feed into wages? Because I imagine if POV is a dominant strategy and you're maybe producing less but selling it for more, then maybe you start to cut back on labor expenses, or maybe you have a slightly smaller workforce and you're paying them slightly more. I don't know.
Yeah,
seems like there's a lot of moving parts there.
There's a lot of moving parts. I would point to Walmart going to $14, right? That's basically the minimum wage of the U.S. being raised to $14. I mean, it's the starting wage is now $14, and there'll be some catch up there. I mean, Lowe's had to invest in their frontline workers heavily. Home Depot did as well. Places like there's Tractor Supply, which is one of the most interesting retailers on the planet.
Tell us why. You know what? I've actually, in my mind, in the backlog, we should do a Tractor Supply episode because that's one of those names that probably a lot of people don't know that company. But I think like the long-term stock chart on that is like insane, right? It's like one of the big secular winners of the last decade or something.
It's been a phenomenal secular winner.
All right, can we take a minute to just have like a little 1 minute discussion? What is Tractor Supply?
They sell live chickens there. Or at least the one close to me does.
So in 1997, this was a $1 stock, and now it's a 226 stock. So nice 3 decades. But what is the story there?
Yeah, so the story there is, from 1997, it's been store growth, phenomenal management team, Listening to those calls, reading the transcripts, it's simply a phenomenal management team. And what they sell are everything from grain and things that you need, grain to feed animals, different farm tools, equipment, hay,
baby chicks.
We got to do a tractors. You know who we should have on, Tracy? Who I bet would be good.
Who
we've had on to talk about tobacco in the Laura Tamtel.
Oh yeah,
he'd be great. He knows all the real American companies. He's like, anyway, sorry, keep going.
But Tractor Supply, one, pays a fair wage and has invested all along with their employees, and two, has had spectacular same-store sales growth through the inflation. Right, they can pass inflation on. Right? It's known to farmers that there's inflation, and people in rural communities that there's inflation, and farmers in rural communities are doing rather well in this environment. I mean, one of the ways I will know price over volume is breaking is when Buc-ee's stops advertising that it's an assistant general manager at a very large gasoline station can make $225,000 a year plus benefits.
Is that true?
It's a sign that sits out in front of every Buc-ee's store I've been to over the last 2 months.
And that's another, gotta do a Buc. I mean, but I'll just say both of my kids, one of their first ever diaper changes was in a Buc-ee's bathroom, and they're famously clean. And so I have a very big affinity towards Buc-ee. Okay,
these are Odd Lots tips. Change your kids' diapers at a Buc-ee's and go to Target for lower prices.
They do have the cleanest bathrooms in the world, and that's like their calling card. Like everyone knows you get a really clean bathroom at Buc-ee's.
Sam, you actually mentioned something that I wanted to ask you, which is, what would make you start to think or suspect that the POV strategy is starting to fall apart?
Sure. So kind of going back to the way that I break it down into goods, services, and leisure, I would like to see leisure break first, right? That's really when people stop spending the incremental money on a very expensive Norwegian cruise or more expensive airline tickets. When that begins to break down, I think you begin to have at least a signal that the consumer is no longer able to take those price increases. And leisure comes first, services second, goods last, right? You have to buy peanut butter. At least I do, or my daughter will have a problem. But you have to buy those staples. So that's called the cadence of POV that I'm looking for. Another rural stock. I'm a big fan of looking at Middle America as a signal for how the economy is doing. Is Polaris Industries. They make snowmobiles and side-by-sides. And one of the things that they have said is we're seeing two things. One, we're seeing volumes not necessarily be that great, but we are seeing pricing go up. Right? So they're pushing price, and that's working on rural America pretty steadily. So I want to see things like that begin to no longer happen. And when that begins to break down, that's kind of the first signal that the consumer is no longer able to take the pricing on, going out to Cracker Barrel or going to Texas Roadhouse, Olive Garden, and their expensive lettuce. That was actually one of the best comments I heard on the conference call. That lettuce was I think it was a $2.5 million headwind.
Wow.
On the cost. Wow. Because they have unlimited soup and salad, and lettuce is really expensive.
Wait, Olive Garden does.
Yeah.
Do you remember the famous Starboard?
Yes.
And they're like, come on, put some salt in the water and cool it with the unlimited breadsticks.
Didn't you write a big like a riposte to that?
That was just some amazing content.
Wait, so you were talking, Sam, about the cadence of people pushing back against price. And so I'm assuming if people start to push back first against leisure activities and then maybe, non-essential goods like a snowmobile, would that be like a signal or a clue that maybe we're heading towards a soft landing?
Well, that depends how the Fed reacts, right? Because it's going to be very difficult in my mind for the FOMC to get off of, we call it 25s for life, until they begin to actually see corporations decelerate pricing. And when Smucker says for 2023 it's 8%, that is not good for the FOMC.
No.
When Cracker Barrel's saying wage increases are 5 to 6%, that's not good for the FOMC. One is a consumer good and one is middle America getting a pay raise. When Walmart's raising their minimum wage, again, That's a pretty big deal when it comes to consumption on the lower end. So do I think it pushes us closer to a softish landing? Oof. I would argue it is going to be rather easy to accidentally read too much into CPI decelerating simply because you're going to have used autos, which you don't consume a used auto all the time. You do consume groceries all the time. It's going to be easy to read in a little too much to CPI and PCE readings over the next few months and be really excited that maybe the Fed doesn't have to go to 550, 575, and then all of a sudden get caught a little off guard when corporations continue to push pricing, trying to find the elasticity on their margin.
I have just like two more questions, but I wonder, we don't get conference call transcripts, obviously, for privately held companies. But, it does seem as though there are differences in how companies that have to be accountable to shareholders every quarter and answer Wall Street analyst questions every quarter behave. We did an episode recently with an investor in Arizona land, and he was saying that the privately held home builders feel more comfortable holding unused land on their balance sheets than the publicly held ones that have to, again, answers like, why are you holding so much land? Don't you remember the great financial crisis? I think there have been stories in the oil patch as well where some of the privately held drillers are a little bit more comfortable expanding, in part because, again, and this is like a Jeff Curry Goldman thing, the exact, profitability over volume, the end of volumetric expansion isn't something investors want to see. Do you have any reason to believe that some of these dynamics that you describe may be different and that maybe some privately held companies see an opportunity for VOP to take advantage of when their publicly traded counterparts are doing POV?
Ooh. I'm trying to think of a good example of that, and call it the oil patch. Being in Houston and I talked to a significant number of these smaller operators. It's kind of two things are playing into it. One, they're feeling cost pressures that are far higher than their publicly traded peers. So their ability to do volume over price is very, very limited at the moment because their publicly traded peers have far more power and scale. It's somewhat different for the private frackers. They're doing a little bit more volume on, call it the margin, but not much. And so it's a much different, I would say, mentality in the oil patch, even with the private guys. But the private guys, it's much more of a cost issue than it is an attempt to do the volume. I'm sure they would. I mean, this is Texas, right?
Yeah.
Drill. It's pretty straightforward. When it comes to consumer goods, it's difficult to find any that have reliable size.
Yeah.
You can kind of look at some of the companies that are growing pretty quickly in the private markets, but it's difficult to parse out exactly whether they're going for volume or if it's just the trend is their friend.
Right. And I just have one last question, but it sort of dawned on me, did odd lots help contribute to the inflation?
I was just thinking about that with all our supply chain episodes.
So it's like if the real story is that companies use news about disruptions, about avian flu, about ports, about semiconductor shortages, about wings, chicken prices as excuses to raise prices rather than so it is okay, we spent 3 years talking about all these things, and then the company's like, thank you, odd lots. Please keep doing stories about disruptions so that we can do the pricing power. Is it all our fault?
I wouldn't say it's all. I mean, there's blame to go around. But there is an interesting part of that egg story. Going into Christmas, the USDA does it does a whole bunch of weird stuff. But one of the best reports out there was a post-Christmas one where it was the largest, they call it disappearing of eggs on record that they had done per person or per household. think it was 8 eggs per household during Christmas. So even with the higher pricing, volumes were up. So that's just an interesting side note.
Yeah.
And I think a lot of it, kind of going back to one of Tracy's points earlier, was we hadn't really been able to get reliably together for Christmas, right?
Yeah.
And, Omicron was, a year ago.
Yep.
So we hadn't been reliably able to get together for Christmas. So we went big on baking this time around.
We were excited to be together again.
I think Tracy baked.
I did. I baked cookies, sugar cookies. Oh my God, they took me forever. I have one more question in an attempt to deflect some of the blame away from Odd Lots. What are companies actually doing with the additional money? Is it actually going to pay off higher input costs and maybe some wage raises like we've been discussing, or is it being returned to shareholders or investment? Like, what are you seeing?
All of the above. It's a combination of needing to offset the input cost increases. They're non-trivial, obviously. Some labor and better return for shareholders, dividends, et cetera. There's a great chart from John Deere on basically the revenue gain off of the price, which is most of it, volume, which is very, very little, if any, and then the material costs, labor costs, and the return to shareholders. And the offset to the input cost increases is 135, 140%. So it's a very interesting, and again, that's basically a duopoly in the US, but it's a very interesting study, and there's enough to go around to cover all of it.
All right, Sam, thank you so much for coming on Odd Lots. That was fantastic, even though it did lead to the realization that we are part of the problem.
Tracy and I feel like the light bulb must have gone up like at the exact same second. I was like, oh, I'm so sorry we did all these episodes.
Yeah. Thanks, Sam.
Thank you.
Joe, I think we should call this excuse inflation.
I like excuse inflation. And you're right, the baker said it. He told us all of it. He said, he's like, even in the past, because this was even his point when he said it was that even like prior to the pandemic, et cetera, when he as a baker was thinking about when to raise prices, which he wanted to do every year, the opportunities best arise when something related like, a flour, disruption in flour or disruption in eggs were in the news. It's like, okay, this is the moment that you can raise prices without consumers pushing back too much. And then the last 3 years have been
nothing but one-off
Excuses.
disruptions.
Yeah.
Lollapalooza of excuses, that's right. But obviously it does raise the question of what can break the cycle. And it does seem, listening to Sam lay out some of the comments that we've seen on earnings calls, it does seem incredibly sticky. And once you have that pricing power and you've managed to push through the price, it feels like there's just very little incentive to reverse that. Like, why would you? If you're Pepsi, why would you start lowering prices?
And, the thing is, and obviously the irony to me, which I think, because people talk about greed and greedflation, right? And it's like, they don't need to be raising prices. They're just expanding their margins. The irony to me is that as long as companies are in this greedflation equilibrium, like a sort of corner of the payoff game theory matrix, the stock prices are not going to do well because this will keep the Fed on the 25 forever standpoint. That's sort of like keeping financial conditions from getting too loose. So the irony is the companies would probably wish they could get out of this part of the matrix because management is mostly going to have their wealth tied to the stock rather than anything else. So it's like a pretty undesirable state for, I think, everyone right now.
What if higher interest rates, which increase interest rate expenses, also end up fueling the POV strategy because you have to make that up in one way or another?
We got to have Warren Mosler on to talk about. We do at some point.
This is definitely an episode that I think has me thinking about like 8 other episodes.
Let's get Larry Hampton on to talk about Tractor Supply, though.
Yeah, okay.
All right.
And chicken wings, obviously. Okay, shall we leave it there for now?
Let's leave it there.
This has been another episode of the Odd Lots podcast. I'm Tracy Alloway. You can follow me on Twitter at Tracy Alloway.
And I'm Joe Weisenthal. You can follow me on Twitter at The Stalwart. Follow our guest, Samuel Rines. He's at Samuel Rines. Follow our producers, Carmen Rodriguez at Carmen Armin and Dashiell Bennett at Dashbot. And check out all of our podcasts at Bloomberg under the handle at Podcasts. And for more Odd Lots content, go to bloomberg.com/oddlots, where we post the transcripts. We have a blog and a newsletter that comes out every Friday. Go there and sign up. Thanks for listening.